I've called this Brief History, Current Problems and Hopes for Reform in Auditing. Couple of caveats before I get going. First one is I'm going to talk mostly about the UK. The principles I'll discuss, I've mentioned a couple of things during the course of the session, but I'm going to talk about the UK in the main because that's where most of my experience is, but the issues are the same all over the world, to be perfectly honest, but I'll talk about the UK. And then the second thing, one of the things Mark was talking to me about was sort of government and private sector audit. I'm going to focus mostly on private sector, happy to deal with questions about government audit stuff as well. But again, the issues tend to be the same on both sides. So I'll stick with the private sector stuff because that's probably where I've got a little bit more experience. And yeah, I've got a couple of video clips as well. So I'm going to start off with a little video clip which has become fairly famous amongst auditors over the last 3 or 4 years. I've got 2 clips from this particular source, which is, and this is going to sound really exciting, the Business Energy Industrial Strategy Select Committee, who have been investigating several audit failures over the last 3 or 4 years, which I'll talk about as we get a bit further through. But this first clip, the phrase that you're going to hear has become a fairly damning phrase on all auditors since it was made a couple of years ago. So I'm going to start off with that video clip and then go into a bit more detail.
Well, you say it's complex. I think it's quite simple, and for me it comes down to this. I wouldn't hire you to do an audit of the contents of my fridge, because when I read it, I wouldn't know what is actually in my fridge or not. And that's the point of auditing, isn't it? To tell us what actually exists and what's there and what's robust.
So, wouldn't trust you to audit the contents of my fridge. That was Peter Kyle MP back in February 2018. That was the BEIS Select Committee looking into the collapse of Carillion back then, addressing their auditors who were KPMG. Let's say that phrase, wouldn't trust you to audit the contents of my fridge, was a pretty damning indictment of KPMG themselves in that particular case, but also the audit profession in general. If you have got like 2 hours of your life with nothing to do, then they are quite interesting select committee hearings to listen to, because you do sit there and think, really, is that what they did or what they didn't do? So, but I thought I'd start off with that because that is a phrase that has really made most auditors go, crikey, yeah, maybe we've got a bit of work to do. So I thought that's just to set the scene. So a bit of explanatory to start off with, and as with all good sort of Methodist sermons, I want to start off by going back to some ancient language that we don't use very much anymore. What does the word audit mean? Not Greek or anything but Latin in this particular case. So audit means to hear, and it comes from auditory and all the other words that sort of link to that. And if you go back in time, the original state of auditors was they were people who would listen to accounts that were being given, not financial accounts, but accounts of events and situations that were being given, and then they would sit there and say, yes, I agree, that is what happened, or yes, that is the situation. So they were the witnesses to an event, and they were listening to a recount, a recollection of the event, and saying, yes, that's right, that's what I heard. So that's where auditing as the word comes from, that sort of phrase, to hear. If you're looking at what an audit is now, in the case of the audit of financial statements, and the word audit is used in lots of different contexts these days, but if we talk about financial statements, which is what we're talking about in this particular forum, this is where I then start to go off to the international standards on auditing. And the objective, it doesn't actually define an audit, it defines the objectives of the auditor, which we can play with semantics, but it's basically the same thing. So the objective of the auditor is to obtain reasonable assurance about whether the financial statements as a whole are free from material misstatement, whether due to fraud or error, thereby enabling the auditor to express an opinion on whether the financial statements are prepared in all material respects in accordance with an applicable financial reporting framework, and to report on those financial statements and communicate as required by the ISAs in accordance with the auditor's findings. I'm going to go to that first paragraph in a bit more detail in just a second. The second paragraph is basically saying, if it's fine, say it's fine. If it's not fine, say what's the matter. That's kind of what that second sentence is trying to do. But that first paragraph, that first sentence, there's some key words in there that's really underpin what is the matter with auditing as it stands at the moment. And those words, I think, are reasonable assurance, material misstatement, and opinion. You might think, what about the fraud? I'll come back to the fraud in a second, but those, I think, are the three words that confuse the general person on the street who wonders what an audit is all about. An audit is not designed to find every single mistake that might be there. It's not designed to give 100%. These are absolutely cast iron, perfectly correct accounts. They are designed to give a reasonable level of assurance. They're designed to make sure there's nothing big that's wrong, but there might be mistakes, but not just for saying there's nothing big that's incorrect. And it is still, at the end of the day, an opinion. It's not a factual decision. It is an opinion based on the information. Well, do we think these accounts look okay or not? The issue with materiality is everybody's materiality is different. And an auditor has to decide based on who are the users of the accounts, the population that's being addressed, what do we think would make a difference to them? So the example I often use when I'm teaching sort of brand new audit trainees is think about your salary, think about your pay slip when it comes through every month. If the figure you've got paid, if your net salary figure is different to last month, how big does that need to be? How big does that difference need to be before you go back to your employer and say, why is that different? So if you got paid £2 less than last month, would you go back to your boss and say, why am I paid £2 less than last month? Or would you go, oh, that's probably a tax thing, that's okay? How much would the difference have to be before you then said, hold on, I want to know what's going on here. I think that's an issue. And that's what materiality is. Of course, in that example lies the big issue that if you were paid, let's say your materiality personally was £20. So you got 20 quid less than last month. And you then go to your boss and say, well, why have I got 20 quid less than last month? What if you got 20 quid more than last month? Would you still go to your boss? Or would your upside be different to your downside? Most people probably would be. Most people think, oh, 20 quid, oh, they probably pay me a bonus, I'll keep my mouth shut. Maybe it's 500 quid, you think, oh, I wasn't expecting that, I might go and check it out. But upside and downside can be different. So the auditor has to navigate their way around this. And I'm not going to be biased one way or the other on this, because I have views about how good or bad audit is, but I'm just trying to paint the picture of where the problems can lie. So materiality is very much a fluid concept. It'll be different for every client. It'll be different for every situation you tend to be in. So this is a problem. This is one of the issues that we have with audit as it stands, because we're not required as auditors to say this is 100% correct. It's, well, within a tolerance, it's okay. And that's one of the issues that we have there. Then to come back to the point about fraud. So what about this fraud and error thing? So again, we're not there to detect every fraud. We're only supposed to be looking for material misstatements, whether caused by fraud or error. If the fraud is somebody's nicked £5 from the petty cash tin, but you're auditing BP, you're never going to go and find that. You're never going to look for that. It's just not material. Still a fraud. That person could still technically be charged with theft and go to prison, etc., if they were found guilty, but you'd never look at it. So again, where's the point at which you would or would not look for these things? So the materiality plays a big part in what auditors do and do not look for. So I think that's one of the things we need to bear in mind. Quick bit of history then, just to run us through sort of where auditing got to from back from the Latin. I'm going to fast forward sort of 1800 years or so, to 1844. So the first Companies Act, the first Joint Stock Companies Act in 1844, when limited companies were created for the first time, mainly around the Industrial Revolution, around railways, to be perfectly honest. That's when the first requirement for audited accounts came along. But anybody could do it. There was no requirement for qualifications, no requirement to be independent. So you could have had one of the directors of the company auditing their own accounts back in 1844. As time moved along then, 1900 Companies Act, that's when independence was first introduced. And we still haven't got it right. 120 odd years later, we still haven't quite got independence correct. We'll come back to that a bit later. And then sort of how auditing has changed over the years. So early 1900s, very much looking at each transaction, ticking, vouching every single transaction to make sure that the transactions look sensible and reasonable. As businesses grew, the realization was, well, we can't really, as the auditors, check every single transaction because it's not time effective, it's not effective from a fees point of view. So the movement sort of became to auditing the balance sheet, auditing the assets and the liabilities. If the assets and liabilities that you're reporting are correct or reasonable anyway, everything else must be okay. So we'll audit the end result. We won't audit the transactions, we'll audit the end result, the balance sheet at the end of the year, but only half of the accounts. Set of accounts is made up of income and expenditure and assets and liabilities. But the idea was, if we audit the assets and liabilities, well, the income expenditure must be right because that ends up balancing out the assets and liabilities at the end of the accounting period. So that was a very sort of popular way of doing things up to the 1960s. In the 70s, sort of through to the 1990s, we switched again away from that to a more what we call controls-based approach. So looking very much at the accounting systems in place and working on the principle, well, if the pipeline works, whatever goes through the pipeline doesn't really matter. As long as the pipeline is okay, what spews out the end of it must be fine. Now, lots of issues around that, particularly when you're looking at sort of volumes of transactions and values. You only need one transaction to go wrong, which is a very big value, and that could cause you a problem. So the controls might work 99.9% of the time, but if the one time it doesn't work, it's a big value transaction, you've got a problem, which was part of the issue behind Enron and Arthur Andersen, which again, I'll come back to a bit later. So that fell out of favour in the sort of early to mid 1990s. That started to fall out of favour, and we switched to very much what was a substantive approach, which is auditing the numbers, both the balance sheet and the income statement, and the control, so much more sort of combined approach. And that's kind of where we are up to this point. We are now about to tip into a new era of auditing, using a lot more data analytics, a lot more AI stuff to dive into companies' accounting systems and do a lot of the work sort of by looking at the entries and the data that backs it up and using much of a data-driven audit. Now, some of this is driven by cost, some of this is driven just by the fact that a computer can be a lot more objective than an auditor. If you're sitting there picking a sample of transactions to test or sample of items to test, every auditor is, to some extent, can be biased. You are going to look at things in a certain way, things that catch your eye. Computer won't do that. Computer can be completely and utterly independent and will pick things based on a set of criteria that you put in. That's the idea. So we are really about to embark on a new era of data-driven analytics and auditing, which is quite exciting. There are some drawbacks to it, which I'll possibly talk about a bit later on. Also, as far as the regulation side of things is concerned, so that's kind of the history of the audit techniques. Audit regulation, up until the early 90s, every company had to be audited. However the techniques worked didn't matter, every company was being audited. But since the beginning of the 90s, we've had audit exemption, partly driven by EU regulation, partly driven just by the government's constant appetite to reduce red tape on businesses. And you can see that now we've got to the stage where a company with turnover of less than £10 million can be audit exempt. Different for charities, different for pension schemes and things like that, but for corporates, we've now got a company, what's called the small companies limit, which is basically £10.2 million of turnover. Now, in lots of people's books, 10 million quid is not that small. And over time, it's crept up. So it used to be 90 grand, so 20 odd years ago. It's crept up and up and up. Have we gone too far? Have we got too many companies that are now exempt from audit? Possibly. But the only way is up, as somebody once wrote a song about on that. And if that limit goes anywhere, the only way that the politicians wanted to go is upwards, to release more companies from red tape. But that is potentially an issue. When we talk about auditors, we can't talk about auditors without mentioning the big however many. It used to be the big six. When I first started in the profession, we had the big six, which were at that stage Pricewaterhouse, KPMG, Deloitte, Ernst & Young, Arthur Andersen and Coopers & Lybrand. Over the years, that's dropped down now to the big four. Arthur Andersen dropped out following Enron. Pricewaterhouse and Coopers & Lybrand merged. I'm not going to say because of Barings, but the merger did happen fairly quickly after Barings. So Barings was the merchant bank that Nick Leeson used to work for. And if you've never seen the film Rogue Trader, it's not the best film in the world to watch. Yeah, Mark will be able to give a writer's eye on that. It's not the best film in the world to watch, but it's an interesting film from the auditing point of view. I did sit in the cinema and gasped at a couple of points about how the auditors were portrayed in that film, which my girlfriend at the time just looked at me and said, "Don't be so sad, Andrew," because I was, they shouldn't be doing that. There's a few things that the auditors did wrong there, but yeah, Coopers & Lybrand were the auditors of Barings. They took a big reputational hit following Barings' collapse. And then it wasn't that long afterwards that they merged with PW at that stage to make the now PwC. So in Arthur Andersen, they were the auditors of Enron. They were the auditors and the advisors to Enron. And the issue there is one of these independence issues that I mentioned earlier on. They were advising Enron on their very interesting share structures. They then audited their very interesting share structures. When the whole thing collapsed, they started shredding paperwork like there was no tomorrow, and were found to be basically obstructing justice by shredding bits of paper, and that led to them losing their audit license in the US, and then the whole thing just spiraled from that particular stage. Again, the Enron story is quite an interesting one. Fundamentally what they were doing is they were borrowing money based on the value of their shares, but they were driving up their own share price. So they would go to the bank, borrow more money, say, "Oh, well, we've got the collateral, which is the equity in our business." But of course, they were driving it up themselves. So the whole thing just spiraled and spiraled and spiraled until somebody said, "What's going on here then?" And then the whole thing collapsed. But yeah, Anderson's did not come out of that particularly well. So those are how the two big firms disappeared. We then, of course, below the big four, we have a whole load of what are now being called the challenger firms. So the firms you may have heard of, people like Grant Thornton, BDO, Mazars, people like that, who are potentially trying to get bigger, trying to get into that marketplace. But again, I'll come back and talk about some of the issues with them a little bit later on, because we've got to a stage really in auditing where we've got the big four, who are really the only firms big enough to deal with some of the big audits that are out there. Because of the international structures they have, and because of the international structures of some of their clients, it's very hard for the challenger firms to break into that big four FTSE 100 type market because of the complexity of the clients that they audit. So we end up with a bit of a closed shop to a certain extent, which is not great. And there are various things afoot to try and sort that out. But again, I'll come back and mention those a bit later on. Regulation, I won't bore you with the regulation too much on this one, but effectively we have two levels of regulation. You have legislation, which drives really who can be an auditor and some of the basics around the audit profession, but nothing particularly exciting in there. mainly driven by EU stuff, but the UK was always very proactive in that case. So there's no Brexit angle to this whatsoever, to be perfectly honest. But then the way we do an audit is driven by professional standards. And it's one of the things about being a profession, that it's not the law that says you do things a certain way, it is the way the profession has developed over the years, that we have our own professional standards, which I mentioned earlier are the international standards in auditing, which are used by pretty much most countries around the world, except the US, notably, who have their own generally accepted auditing standards, which are not massively different, but they're not the same, because the US don't like doing anything the same that other people do, so they have their own particular take on it. But they also have something which lots of countries don't have, which is this thing called Sarbanes-Oxley, or SOX, you'll hear it occasionally referred to, which is enhanced audit reporting around controls. So generally across the world, auditors report on the financial statements, but they're not required to report directly on the controls and systems that clients have. They will look at them, and if there's weaknesses, they'll talk to the company about the weaknesses, but they're not required to report to the outside world in lots of detail about the controls. In the US, they are. Under Sarbanes-Oxley, there are specific things they have to talk about as far as systems and controls are concerned. If you look at any country around the world which is talking about improving audit quality and driving up auditing standards, this is the thing they always talk about. Oh, are we going to introduce a SOX type requirement into UK law or into EU law to try and drive that up? So far, firms have kind of pushed back against it. So was there any real need for it? SOX was introduced off the back of Enron, because obviously that happened in the US, and the US government decided they needed to do something. I have views about SOX. I certainly think SOX is quite a good idea. I think it's good that the auditors are required to talk about systems and controls. It does involve more work. It does involve more cost, because the work needs to be done. So there are pros and cons to it, but personally, I think it's quite a good thing to have in there. So that's where the rules and regulations come from. The regulators, who actually regulates auditors, historically it's been sort of the local countrywide institute. So the ICAW, the Institute of Chartered Accountants in England and Wales, used to regulate UK auditors. The AICPA in the States, the American Institute of Chartered Practicing Accountants, they regulated the auditors in the US. However, that has moved over the years to independent regulation. So we now have in the UK the Financial Reporting Council, who are soon to be go through a name change. It's not just a name change; they're being disestablished and re-established properly as the Auditing, Reporting, Governance Authority. That's part of the move to try and give them more power and more oomph over the profession. US have the PCOAB, which is again the same sort of thing. So independent regulation has become a feature over the last 10 years or so, actually a bit more than that, 15 years or so, around auditing. So there is a bit more independent regulation, but say previously it was very much kind of self-regulation through your local institutes, but that has become a bit more independent over the years. The other thing that's important to mention as part of this rules and regulations bit is about ethics. Because we're professional organisations and we have a professional body behind us and haven't got lots of laws, but we do have ethical standards that we're supposed to follow. So all auditors, and again, this tweaks slightly around the world, but it's pretty much consistent around the world, have to act with integrity, have objectivity, professional competence and due care, maintain confidentiality, act in a professional manner, and must be independent. And you might think independent surely should be at the top of that list. It's not, it's at the bottom, but it is one of the most important things. But it does tend to appear at the bottom of the list in most cases. And there are particular rules around independence. So things like you are not supposed to have any self-interest in an audit client. So the auditors, be that the audit partner or staff involved in the audit, should not have any interest in audit clients, shareholdings, family relationships, things like that. You should not be reviewing your own work. So Auditors should not be preparing the accounts and then auditing the accounts as well, which is an issue for the smaller end. At the big end, it's fine because the FRC impose rules in the UK that actually ban you doing joint services. So you cannot do the accounts preparation and the audit. You can do consultancy work and audit, but you can't do accounts and audit because that's banned. But at the lower end, it's what people expect. Your high street accountancy firm, if you're a family-run business running near the local farm or something like that, and you go to your high street accountant, you expect them to do your tax, your accounts, your audit. You don't want to have a separate firm doing this and a separate firm doing that. So independence is something that kind of has to scale to a certain extent. And again, where you draw the line on this can be a bit of an issue. Management threat, auditors are not allowed to take on management roles. Now, you might think, well, that's obvious. You can't be the director and the auditor. Well, no, it doesn't mean that. What it means is if the directors of the company say, I don't know how to deal with such and such an issue, auditors, what do you think we should do? The auditors cannot make decisions that the directors should be making. The auditors can say, well, look, here's the rules. You go off and decide what you think you're going to do, and then we can tell you if it's right or wrong, but the auditor should not make those decisions for them. However, how that tends to work in practice is kind of what I describe as being the 3-card trick, whereas the auditors will say, well, you could do A, B, or C. Here's the rules. You don't know what to do. Okay, well, your options are A, B, or C, but you kind of pick A. The magician forces you to pick the one they want you to pick. And that's sometimes where we end up with a bit of a problem, where there's this blurred line between the auditor and management. So that can become a bit of an issue. Familiarity, not supposed to act for a particular audit client for more than a certain length of time. Again, over time, this has become a really muddied area. For your listed companies, it's quite clear, 5 years, mandatory rotation. Now, what that means in real life is not firms, but sign-off partner. So the RI, the responsible individual for the audit, is not supposed to sign off the audit for more than 5 years. It's supposed to rotate after 5 years. The really good firms, the really good companies will change firm completely. So they'll move from EY to PwC or something like that. But in practice, that's not what the rules require. The rules require the audit team not to be the same for more than 5 years. So you change partner. But then you end up with the problem I mentioned before. There's only 4 big firms out there. If you're a big FTSE 100 company and you are going to mandatorily move auditors, you're only going to be able to move from PwC to KPMG to Deloitte or to EY, and then 20 years you move back where you started again. And it's an issue. It's an issue that you're moving from firm to firm, and actually each time you move, it's a big cost, and the businesses don't really like it very much. It's a bit of a pain for them to do that. So there's lots of tension around this whole familiarity thing. Come outside the FTSE 100, well, sorry, outside the public interest businesses anyway, the FTSE 100, the FTSE 250, come outside of those, rotations every 10 years, and there are a whole plethora of ways you can get around that. One of the ways, and this is probably the worst part of the ethical standards, to be honest, is it says, well, if you talk to the client and the client says, well, I think you're still independent, then you can carry on. Which feels a bit silly, to be perfectly honest. I've never really understood why that's there, but that's what it says. Talk to the client. If the client still thinks you're independent, then off you trot, you can carry on doing the audit again, which again always seemed a bit daft to me. Advocacy, there's pretty much a ban on advocacy. You cannot be the advocate for a firm that you're doing the audit for, which kind of makes some sense. How would that work in real life? Well, in real life, it comes up in several different guises. Typically things like tax tribunals. If a business is taken to court because of a tax issue, your auditor cannot stand up and say, yes, we think you've done the right thing. They can't advocate on your behalf in a tax situation. So in corporate finance issues as well, the auditor can't sponsor you through a corporate finance deal or something like that. But most firms are pretty good at that. You don't tend to find many advocacy issues cropping up. And the final one is intimidation. Now, this may look like a weird one to have on the list, it doesn't mean you're beating somebody up type intimidation. It means intimidation from fee pressure. So if the business you're auditing threatens you in some sort of way by saying, well, look, we're not going to pay your audit fee unless you do such and such, then the rules are very clear. Well, in that case, you just stop doing the audit. You do not cave into fee intimidation. You just don't do it. Particular issues that have been around for a couple of years, sort of around the pandemic, is businesses that haven't paid their fees from previous years, because then you've got your auditors over a barrel to a certain extent. You didn't pay last year's audit fee. Now you can start this year's audit. Well, now we've got a lot of leverage over you, haven't we? Because you've got effectively 2 years' fees in play. And if you're not nice to us, we're not going to pay any of your fees. So you're not supposed to start audit number 2 until you've been paid for audit number 1, for example. So that's how the standards work there. So these things are in place, but there is a lot of greyness around some of the areas. They are tweaked on a reasonably regular basis. When people find, I won't call them loopholes, but greyness in there, they try to remove the grey. But certainly at the rotation bit, the familiarity threat bit, is a constant thorn in the side, because you've got the battling ideas of, well, the longer I've audited you, the better I know you, and the better I know how things might go wrong, versus the longer I've audited you, maybe I get too comfortable, I don't look at things in as much detail. There's that constant sort of battle in that particular area. So it's an interesting one to think about. Pick up a couple of the recent headline ones. I've mentioned Carillion already. KPMG with the auditors, Carillion. BHS audited by PwC. Patisserie Valerie audited by Grant Thornton. Those have all hit the headlines over the last 2 or 3 years. I'll just give you quick headlines on each of them. I don't want to talk about these for too long, but BHS, PwC, the biggest thing coming out of that from the professionals point of view was that 10 times their fee income came from advisory versus audit. So the audit fee was a very, very small part of the income PwC got. Most of it came from advisory. Actually, it was okay. They'd split the work up properly according to the ethics, but it still looked really dodgy when you look at the numbers. But it was technically okay, but principles probably wasn't. Also, they backdated the audit file. So they made the audit file look like it was signed off a few days before it actually was. And they sent an email. The manager sent the partner an email saying, please sign this off and date it 3 days ago, whatever. So that just looked really terrible. Carillion, lots of really complicated contracts involved in Carillion, which fell on top of themselves. There were contracts in place where if the contract went, or if the deal went one way, Carillion were paying their contractor. If the deal went the other way, the contract had to pay Carillion. KPMG basically didn't seem to understand how the contracts worked, didn't understand the risks involved in those contracts, and therefore there were potential audit issues they could have flagged up earlier. KPMG couldn't have stopped what happened, but they could have flagged what was going to happen or what could have happened earlier. So that's what happened with KPMG. Pat Val and Grant Thornton. This one, again, there's another video clip I'll show you in just a second on the back of this one. Several problems with this one. Basically, a bad audit team. The auditors didn't know what they were doing properly. There were several examples of what I would call week 1 baby auditor training stuff that was done badly. So again, I'll show you a video clip in just a second of one of the examples of this, but GT came out of this looking really, really silly, to be perfectly honest, and they're now spending literally millions of pounds trying to shore up the quality of audit within their practice. They are spending money as no tomorrow. They're recruiting trainers, they're recruiting methodology developers to try and shore that one up. And so I'll play a little video clip of that in just a second. And then even last week, Rolls-Royce, KPMG, the auditors of Rolls-Royce, they got a massive £14 million fine for the audit of Rolls-Royce because they hadn't investigated in sufficient detail alleged bribery allegations around Rolls-Royce dealings with certain of their customers. So they got a severe rap over the knuckles in that case as well, and so a £40 million fine. So those are some of the big ones. I'm going to go on a limb here and say that this sort of stuff has been going on a lot for years. The reason it's become more well known over the last few years is because it's big, high profile businesses people have heard of. People have heard of BHS, people have heard of Pat Bell, people have heard of Carillion. You go into a hospital, or you went into a hospital, your Carillion probably ran the cleaning contract in the hospital or something like that. People had heard of these businesses. These things had happened before, but I think it's the profile that drove some of the headlines this time around. But again, just going to play you a little video clip from this is Bays again investigating the future of audit, but talking to the head of Grant Thornton, not about Pat Val specifically, because they weren't allowed to ask the question because it was still being investigated, but just asking a general principle question. And it's my friend Peter Kyle again, because he's good value for money when he sits on the Bays committee. So let's just play this little video clip as well.
That's very helpful. If I could turn to you, David Dunkley, we can't talk directly about Patisserie Valerie, but could you talk us through specifically what measures do you take as an auditor when you are undertaking an audit to expose criminal activity that's going on within companies and to make sure that fraud, should it be happening within a company, is discovered?
I think that's the very heart of the future of audit. And as I say, I can't talk about Patisserie Valerie. There's a live investigation which we'll cooperate with. But there is a clear expectation gap. An audit fundamentally gives a reasonable opinion on historic information and doesn't look for fraud. The market, the market expects that it's doing all of those things. So we have that expectation gap which needs to be fixed. And that's why. Are you confident that
your systems are robust at the moment?
I'm confident our system. We've invested heavily in our systems, in our quality, such that, yes, I am confident.
So I'm not an accountant, I'm not an auditor, so I have just a question that I need to have answered to myself.
Yes.
When you have a company that is getting to year end, and this is hypothetical, this is in general, when you have a company that's getting towards year end, doesn't have enough money in its system, and writes a cheque from a current account that doesn't have enough money in it, and and deposits that cheque in another of its own company's accounts, and then takes the money that has been deposited, even though the money doesn't exist, and the cheque will bounce several days later, and then adds it to its balance. Isn't it extraordinary that the auditor wouldn't pick this up? Wouldn't the consumer?
Absolutely, the consumer would expect that to be picked up, and hypothetically, if in a hypothetical situation, you'd ordinarily expect the auditor to pick that up.
So what are the implications then for an audit company if it didn't pick that up?
Clearly, the company would have to look at its own systems and the acts of the individuals at the time.
Now, of course, the audit company isn't committing a crime in that case, but its fingerprints would be all over the crime scene.
We have a set of regulations as auditors, and there's two issues. One is there's a set of regulations. The regulator says, have you fulfilled the regulations? There is a separate question as to are the regulations fit for purpose and delivering what the market wants.
If an audit company isn't picking up on this type of behaviour, what is the point of audit in the first place?
I think that
So I'm not going to carry on with that because he does burble quite a lot at this stage, bless him. So yeah, two things to pick up on there. Number one, beginning when he sort of says an auditor looking for historical financial information, blah, 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 and doesn't look for fraud, that's wrong, because that explanation I gave you right at the very, very beginning, it does look for fraud, but only material fraud. So saying it doesn't look for fraud is wrong, and he was wrong in that. And that's slightly worrying when he's the senior partner of Grant Thornton and is still the senior partner of Grant Thornton now, so 4 years later. Saying that, I think that's not particularly clever. But the example they gave that Peter Carl just did, that's exactly what happened at Pat Valve. They moved money that didn't exist from account 1 to account 2 at the year end, took advantage of the fact that your money takes 2 or 3 days to clear through the banking system. And the auditors didn't check that the money did actually come out of account 1 and pop into account 2. They didn't check the balances, the bank statements post year end to see the money actually arrived. I'd say that is week 1 auditing. I taught that to thousands of audit trainees in week one, that you look at the post-year-end bank statements, did what they said happened at the year end actually happen? So that's really quite scary that something that basic went wrong in Pat Val, and so that it did. It's there in black and white in the report. So quite interesting. And again, if you watch the rest of that clip, that's a different one. It's different hearing to the one I showed you earlier on, because you can see Peter Carr's wearing a different shirt. But again, they are really quite squirmy. You think, you really don't have a clue, do you? These people heading up these audit firms. So what are the issues? Let's do a quick sort of run through the issues before we wrap this up. So I've got them in three groups. Okay, so first of all, issues that audit customers see. First thing is always cost. So an audit costs a fair amount of money to have done, and it's a zero gain product as far as I'm concerned. It's a distress purchase. If companies didn't have to have an audit, they would rather not pay for it, so they have to have it. So it's always seen as, oh God, we would pay out for an audit. That's not particularly helpful. And at the bottom end of the market, the owner managed businesses end of the market, it's seen as, well, what's the point in this? Why do we have to have an audit? Because all you're doing is telling me that my accounts are okay. I know they're okay because I wrote them. And there's this lack of understanding of the bigger societal benefits to accounts being audited. And actually, there is a wider group of people that are interested. There are banks, there are potential shareholders, there are employees, there are pension schemes. There's lots of people who are interested in what a set of accounts looks like. But if you're on the inside, you're the directors, you're thinking, well, I'm paying out this money for what particular reason, and I don't really see the benefit. I know my numbers are okay anyway. The enlightened directors will say, actually, I do want auditors because I'm not hands-on in the finance department. I want somebody to come and check the finance department on my behalf. But unfortunately, there's a lot of people out there who say, well, I know my finance department is really good. I don't need somebody else to come and tell me that. So you have this issue. The second group are the things I've alluded to during the course of this chat already, which is independence. Are auditors actually independent enough, or are they much more in bed with the clients because they're trying to get advisory work, tax work, etc. out of them as well? Is that an issue? So something is trying to be addressed, but every time you go down that particular pathway, there's a lot of special interest groups out there saying, oh, actually, it's useful for us to do the audit and the accounts and the tax, etc. So there's a lot of resistance to that, certainly at the bottom end of the market. There's the competence issue, which you can see with the GT example there, trying to raise the standards and the quality. And then there's also this issue about appetite. Now, I mentioned the challenger firms earlier on, and the big four basically dominate the FTSE 100, and actually most of the FTSE 250 as well, to be fair. And is there the appetite for the challenger firms to actually take them on? Would the BDOs and the Grant Thorntons of this world want to do the audit of BP or Shell? The answer is no. They absolutely wouldn't. They'd say, crumbs, that's complicated, it's risky, it's multinational. We don't want to touch that. And there's been a really good example of that recently with Sports Direct, or the Frasers Group, as they're now called, Mike Ashley, the Frasers Group. They parted ways with their long-term auditor, and none of the big four firms wanted to take that audit on. And very few of the challenger firms wanted to either. And what happens in that situation, if nobody wants to be the auditor of the company, you have to go to the Secretary of State for business, energy, industrial strategy now, and they will appoint an auditor for you. Now, RSM have actually taken on the audit of Sports Direct. It's not entirely clear whether they decided to bid for it or whether they were sort of basically told by the Secretary of State, look, we want you to do it. It's all a bit smoke and mirrors. All the press releases say, yes, we're really pleased to take on this high profile client, but back at the time, nobody wanted to touch Sports Direct with a barge pole. So it's quite interesting. Where's the appetite? Do the challenger firms actually want to take on these big jobs, or actually are the big four you're going to take it all on anyway? And then you've got the this thing about the expectation gap that David Dunkley mentioned. What actually is the audit supposed to be trying to do? What do people understand the audit? Do people want the audit to do more than it really does? So is fraud something that should be more front and centre of the audit? Should the duty of care be wider than just to the shareholders? That's where the duty of care lies at the moment. The auditor's duty of care is legally purely and simply to the shareholders, not to anybody else. So should that duty of care be wider? Should fraud be considered as well? So those are some of the issues there. So this thing, the expectation gap, the difference between what the public thinks an audit is and what the profession thinks an audit is. Over the years, the way to try and close that gap has been through regulation, ISAs, things like that, but also reporting. Let's put more and more words in the audit reports to explain what we do. Personally, I don't think that's worked. I think that we now have way too long an audit report and people just get bored halfway through it and don't understand the words in there. So I don't think that's particularly worked myself, but that's where we are. And so who suffers? If the audit doesn't pick up what's going on, who suffers? Do the directors suffer? Not usually. Directors have usually paid themselves big bonuses and big remuneration in the run-up to something going wrong. Business collapses, well, they've already got the money in the bank, so that's all fine. And there's very few clawbacks if an audit goes wrong. The city, well, possibly, but again, businesses fail. It's part of risk mitigation, very portfolios across the city. One company going wrong doesn't particularly affect them. Small investors, yes. If you've got your whole life savings invested in one company, if you invested all your life savings in BHS shares, your investment was wiped out. So small investors, yes, get affected. But the big group that get affected is pensioners, so particularly those defined benefit pension scheme pensioners who, when one of these big companies collapses, they're left without a sponsor for their share of their own pension scheme, and therefore who's going to top the pension scheme up over time. So pensioners are the big constituency, I think, that suffer when audit goes wrong. So a couple of thoughts about the future, and then I'll wrap it up. So what's audit going to look like going forward? Should an audit look at things like the ethicality of tax structures? It's not the auditor's job to say, do we think you're paying a reasonable amount of tax? Do we think you've been aggressive in your interpretation of tax structures? All the auditor has to do is say, well, is it legal? Yes or no? Yes, it's legal. Fine, off we go. So should that be something that auditors think about? Should auditors be brought in to think about things like ESG? There is a move to bring a standard in that's going to drive some disclosure around ESG, and how much auditors will get involved in that, I don't know, but is that something that auditors should be getting more involved in? Do auditors need to be more professionally skeptical? This is the phrase you're going to keep hearing. If you do any research into audit, you're going to keep hearing this phrase, professional skepticism. Yes, auditors need to be much more questioning about what's going on, not taking what the client tells them, but actually asking questions and say, well, where's that come from? And why are you doing it this way? They need to be asking more questions rather than just accepting what clients tell them. So that definitely is something that needs to happen. Audit, future of audit in the UK was mentioned in the Queen's speech a couple of weeks ago. Prince Charles didn't actually mention it verbally, but if you look at the press release that came with it, there is a bill on the future of audit in the Queen's speech for this year. One of the things they want to open up the audit market by introducing this idea of shared audits. So I said the challenger firms don't want to take on a big FTSE 100 audit. So the idea is, well, let's force the big four to share the audit. The issue around that is huge, because if something goes wrong, where's the liability going to sit? And at the moment, they're trying to thrash out how that's going to work. But again, the challenger firms, they're not overly excited about this as an idea. Why would we want to take on a bit of the audit of BP? Because we'll either end up with something that's so simple that we get few fees out of it, or something that's so risky that we don't want to do it. So is that going to work? I'm skeptical about that, if I'm perfectly honest. Bringing more companies into the scope of what's called public interest. Not entirely sure how that's going to affect the audit profession, but that's something that's in there. But the market is nothing in the Queen's speech about really banning audit and consultancy in the same firms. something that's been mentioned several times in all the run up to this, but it's not in the bill, not in the draft bill. So going forward, what's going to happen? What some of the firms though are doing is they are starting to take the initiative themselves. So, for example, a couple of weeks ago, EY announced that they are going to split their audit business out of the rest of the partnership. The other big four firms are thinking about something similar. There is a move to maybe try and create another big firm, so to get to a big five or big six again. Interesting to see how that's going to work. There's a couple of firms that have been quite aggressive in buying up smaller audit practices and growing themselves. So there's a bit of a behind that. So we'll see what happens. One of the things that was recommended in one of the reviews that was carried out is actually separating the audit profession out, because at the moment it's a chartered accountancy or certified accountancy profession. To be an auditor, you have to be a chartered accountant. It's actually to split that off and say, let's have a completely separate profession for auditors. Personally, I think that's a silly idea. I can't see what the benefit of that is myself, because the training will be exactly the same. You're just going to pick a load of people up and drop them in a different pile. But it may look good on paper. I don't think it's going to really work in practice. Better training, yes, absolutely. Making the staff more knowledgeable. I think that's important. But the other thing I think is quite important is about sort of the fees and the timing. One of the key things you see with all the failures is the auditors didn't have enough time. They were time pressured into doing things and getting things signed off too quickly. So having more time, more space, that might mean things like the city having to be more realistic about when to expect results. One of the big time pressures for the bigger audit firms is the city want numbers pretty soon after a year end, and the audit needs to be done between the year end and when the city announcement happens. So changing that timescale might help a little bit, give the auditors more time to actually see what the heck is going on, rather than forcing them to get an announcement out in 4 or 5 weeks, which can be quite tricky. So again, that's something else to think about. And that's it. So that's my sort of potted history of audit. Sorry, I've chatted on quite a long time. But that's kind of my thoughts around the audit space. So happy to deal with any questions that anybody might have.